Welcome back. We are back with Sadiq Adatia, Chief Investment Officer at BMO Global Asset Management, for his view on the Canadian side of the border. We talked about U.S. Stocks and the U.S. economy in our earlier chat. First of all, the Bank of Canada, of course, makes an announcement tomorrow, just a little more than 24 hours from now. What is your expectation?
Yeah, this is a coin flip for us. I think we might see a 50 basis point rate cut here. I'm okay if they did 25, to be honest with you, and continued that down into next year. But I think they'll remain aggressive for the remainder of the year. For the remainder of 2025, because I do think they're looking at the underlying economy, and there is weakness there. Unemployment continues to go higher, even though we saw job creation. There's more participants that are getting in the workforce. I think when you look across the broader picture, it's not as strong as the U.S., and I think, therefore, they can continue to be a bit more aggressive than the Fed. And
is this why you are less bullish on Canadian stocks than U.S. stocks? You say you're neutral on Canadian stocks.
Yeah, and I will highlight that a couple of months ago, we actually upgraded Canada from being underweight, and it's because of a couple of things. One is, I think the cutting of interest rates will be helpful for the consumer gradually over time. I think the U.S. strength will be a positive for Canada. And I know everybody's looking at this 25% tariff, potentially. I don't think that's a high probability event. I think, when anybody starts a negotiation, no one starts at a low number. They start at a high number and eventually get down. So I do think that's an important thing to understand. But I don't think it's a 0% probability of no tariffs either, right? I do think we're going to get something in there along the way, more targeted. But U.S. is relying on us on energy as well. So I think we will get a benefit off the strength in the U.S. economy. And that should bring us a little bit better than what we see the rest of the world that's international in Europe. So part of our neutral or upgrade that we brought to Canada is because we think the other parts of the world are not going to be as strong a benefit.
Now, what exactly does neutral mean in portfolio positioning?
Yeah, so when we have our long-term strategic asset allocation, we're not deviating from that, right? In the U.S., we're overweighting equities by being, anywhere between 2.5% and 5% overweight equities. In Canada, we're probably slightly a little bit overweight equities. Whereas international and emerging markets, we're underweight for sure. So we generally, where we're looking at this as some opportunities within the space, we want to be more targeted within Canada. So areas like financials, you mentioned gold is another area that we've been bullish on. We think segments of Canada are going to do much better than the broader market itself.
What's your view of the Canadian financials? We spoke about the U.S. financials earlier. There's a lot of pretty positive sentiment now around the Canadian financials, and it's been reflected in what the stocks have done over the past 6 months or so.
Yeah, I think you're seeing some momentum and some strength there. I think as people look around the Canadian banks, I think they're going to look at loan loss provisions eventually coming down a little bit. Again, the weakness that you see in the consumer might be helped out a little bit with lower interest rates. The wealth impact is also not bad either in Canada and the U.S. Markets have been higher. Housing values are starting to come back a little bit. So you see some benefit from that as well.
Why don't we talk about gold? We've mentioned it in passing a couple of times.
Yeah, gold has been one of our best positions that we've had. We've done exceptionally well owning it back in, I think, September 2023. And a lot of people got a little bit more bearish when Trump took over. I mean, sure, you wanted to own gold into the election, but I think you also have to hold gold for the uncertainty of Trump. And geopolitical risks, as we talked about earlier, the tariff, a potential war that could occur as a result of that. These are things that you want to be cautious about and have things in your portfolio that can mitigate the overweight you have towards equities. And we've seen gold time and time be a very good hedge against that sort of scenario. And we also have central governments around the world.
Central banks.
Buying more and more gold as a result of trying to move away from the U.S. dollar currency, right? So I think that's a key part of that story as well.
So when you say you're holding gold, are you holding the actual metal, right?
Yeah. We like the physical gold better than the underlying equity names. The reason is because the equity gets part of the equity markets, but also you have to worry about management and other things.
Right.
We want the pure gold because we think that's the right hedge against volatility in markets.
And what is your view on how much of a portfolio should be devoted to gold? You've got model portfolios, I guess, that we're talking about here, right?
Yeah, these are our actual, our ETF portfolios or managed portfolios that BMO manages. And so we have an allocation. So generally, we don't put a strategic asset allocation weight towards gold, but tactically, when we see things like what we're seeing today, we add it in there. So it can range anywhere from 0 to 10%. Today, we're probably, depending on which portfolio, looking at around roughly about 5% allocation towards gold.
Okay, going back right to the beginning of our conversation in the earlier segment, you do think there's going to be volatility. You do think there's the possibility for pullbacks, and in that vein, I gather you've got hedges in place as portfolio insurance. So why don't we talk about that?
Yeah. So two things. In sort of volatile environments, as much as you're bullish about things, you always have to worry about what could go wrong. And so think about it as I always joke about when you drive a car. You have the airbags. You never want to use them, but you have them just in case. That's what we talk about when we have gold or hedges in terms of option strategies, so puts to protect against that. The key is actually we want to be buyers on some of those big dips. And so if we get them, we're going to be excited about that. And if we have hedges in place, then we have the opportunity to be able to take those hedges off and then buy those positions into those pullbacks.